Very good to meet you.
Cheryl?
Mark, thanks very much.
In other words, you're taking a case
I need this schedule.
Yes, I just have. Oh, well, it comes with a couple of dollars. Yeah. I mean.
So how's everyone doing? Great? Okay, folks, as I said, we're not taking a break. Gentlemen on the front, we need to take conversations outside. Leo, outside. George, if I can invite you up to join us in the front. Steve, if you could help George find a seat up here. Yes.
Thanks, I wasn't taking a chance. Thank you.
Thank you all for joining us, and thank you for your attention. Now I'm going to ask for conversations to cease. Martin, my friend, Bear's Lair. I'll do it. Martin Hutchinson. We're going to bring conversations to a close for a moment. I apologize that we run this so thoroughly through. Martin Hutchinson, seating partner. There we go. We have to run a tight ship because there's so many speakers here. This is the 7th inning stretch. We've had a very, very interesting, robust discussion about the domestic drivers of growth and thinking about this question of what could replace, if anything, the American consumer as we tilt towards the G-20 London Summit. And now we're going to have a discussion on the international dimensions of this question and the question of can global demand come to the rescue? What must we see from the G-20 London Summit? And we have got a very distinguished panel. To my far right, Cheryl Schweninger, whom you've just heard moderating the past panel, our partner in helping to produce today's program, my colleague here at the New American Foundation who runs the Economic Growth Program. He and Bernard Schwartz have written a very important essay for us that is somewhat the manifesto for at least our own institutional thinking about this question, which is available on the net for those people watching online. I've just been told we've had several thousand people that spend at least 6 minutes, that's the benchmark, watching live online. So we've gotten a multiplier already out of today's event. So we want to thank Desmond Lockman, resident fellow at the American Enterprise Institute, is the only person I know who can rival Martin Wolf's pessimism about the future. My good friend and former boss, Clyde Prestowitz, president and founder of the Economic Strategy Institute, who himself in the 1990s were wrestling with many of these same themes back then, and I will steal his line, it is deja vu all over again, right? And Nicholas Lardy, senior fellow for the Peterson Institute for International Economics and one of this town's most knowledgeable and formidable intellectuals on what's happening in China. And also on the China front, William Garrity, a new member of the board of the New America Foundation, chairman and CEO of Garrity International, who I hope will teach me a bit more about mall building and whatnot in China and how it fits into this question. So I'm going to start with Cheryl. We're asking for just a quick opening, two or 3 minutes, the zingers, if you will, that you think matter as we look towards April 2nd on the international front. And so that let's leave the domestic side, let's leave the picture of the United States. What must we see in London? What keeps you up at night? Or what do you think we're getting right? Cheryl.
Well, I think Martin Wolf captured many of the key things that have to happen in his opening presentation in terms of particularly the responsibility and the importance of the current account surplus countries coming forward with major stimulus and structural reforms that increase their demand creation. Now, having said that, as you pointed out, we have known about this day of reckoning for 10 years or longer. I mean, Clyde and Desmond and others have all written about it. We've all talked about it. we knew that we were going to have to engineer a global rebalancing, and we've been speculating how it would happen. What is so tragic is the time has arrived and how ill-prepared the world really was in terms of building any kind of consensus. And that's why the G20 will probably fall short. And the second thing that has been very discouraging, therefore, is that all the countries, all the major economies are responding to the crisis almost in character form. A lot of the effort of the U.S. stimulus is aimed at resurrecting debt finance consumption. Obviously, there's some good parts that try to get us towards greater infrastructure spending, but we're responding in character form. China, which is doing a lot, nonetheless, overwhelmingly their focus is sustaining their export sector, increasing fixed investment and infrastructure spending. They don't have the structural mechanisms to encourage a rapid buildup of consumption and consumer demand, although they've pointed a little bit in that direction. Germany is responding exactly in kind and character. This leaves us with a very serious dilemma in thinking about not just the G20, but the future of the global economy, and that we may not get that optimal global rebalancing that we all have been advocating and calling for. And therefore we're going to have to think quickly about what are second best solutions. And the second best solution probably is a variation of what was Bretton Woods II, but with some measures taken to eliminate some of its more deleterious elements. In other words, the supply of safe assets will be U.S. public debt and not private debt. There'll be slower growth in those export economies because there'll be less private sector demand. But there are ways to be able to make certain policy reforms that will make a Bretton Woods III less harmful, both to the middle-class American economy and better for the world, to give us time to get back to build the consensus for a more optimal rebalancing. So more of American demand will have to be on public investment and expansion of public demand and improving the public quality of life. We'll have to do more to protect, preserve, and expand America's future strategic industries. And we will have to do more to reduce the need and incentive for countries to build up huge caches of foreign exchange reserves. So we will have to use, and this is the one hopeful sign, I think, as George Soros has pointed out, that we will have to strengthen those public international institutions that failed us so much in the 90s. We will have to make them viable transmitters and mediators of international capital flows to ensure that developing economies can expand demand and run budget deficits and current account deficits. So there's three things that we can do that are not the optimal rebalancing, but make a system work for another 5 to 10 years so that we have time to get us to a fuller rewiring of the global economy.
Thank you. Desmond Lockman.
Thank you very much for inviting me, and perhaps I just want to start by drawing a distinction between pessimism and realism. And in that vein, I would just say that I'm not expecting too much from this G20 meeting. If the ministers of finance can't come to some kind of agreement, I don't know why we're expecting the heads of state to suddenly resolve all of these difficulties. And I'm not sure that with as many as 22 countries represented, that this is the exact forum that you're going to get decisions on key issues. Let me just start by just setting the scene for this G20 meeting. I think that it's very important to realize that what we've got is we've got a synchronized global meltdown. Not to put a fine point on it, the US GDP contracted by something like 6.5% in the fourth quarter. We've got Europe going down at the same rate. Japan is going down at a rate 12%. The numbers look rather awful. And I think that the stakes are particularly high for getting coordinated policy stimulus to break the cycle, that there is a real danger. And my fear is not simply, that the U.S. fiscal stimulus package was too backloaded, not well directed, that we haven't really got to act together on sorting out the financial system, but that Germany seems to be in denial. And what we've got is Japan, even if Japan recognized the problem, there's not a whole lot they can do about it, having squandered past opportunities, piled up too much debt, facing deflation problems going forward. So the real hope is on Germany, and the risk that I'm concerned about is not simply Eastern Europe, which is on the brink of default, but Western Europe, that we've got European banks that have lent something like $1.5 trillion. Austria's managed to lend something like 70% of its GDP to East European countries that aren't going to be repaying it. Sweden, Switzerland have got problems as well. So I would have thought there's an imperative for Germany to provide an adequate, good environment for these East European countries to work their way out. These countries are very export dependent, and if you don't have adequate export markets, there's no way that they're going to work their way out, and they're really just going to have trouble dealing with the capital stop that they've got. If I haven't added sufficient realism, I should just conclude by saying that the problems aren't simply in East Europe, but there's serious problems in West European countries. I don't know how within the basic problem is that the euro is not an optimum currency area. We've now got it really very stressed, and we've got countries like Spain and Ireland with housing problems that make those in the United States look pale, the bursting of those bubbles, their competitiveness problems, they're running current account deficits in double-digit figures, and this is really going to require a long slog. Once again, if Germany doesn't really move on this G20, I think we're in deep trouble.
Clyde Prestwitz.
Steve, thank you. As Steve knows, I have a reputation for being provocative, and so let me try to be a little provocative here. I fully share Martin Wolf's pessimism, fear. I think we are in desperate times. Desperate times require bold measures, thinking the unthinkable. Several speakers, Martin first, have made the point that we have a world divided between the surplus countries, primarily China, Japan, Germany, and the Anglo countries as the deficit buyers of last resort. And so I think that this problem, one way to address this problem is in fact to divide it in half. I was in Asia just before Christmas, and I had the opportunity to interview a prominent Asian prime minister whose country consistently accumulates large current account surpluses. And in the course of the interview, I said to him, Mr. Prime Minister, does your country have to have a surplus, a current account surplus, every year? And his answer wasn't yes. It was damn right. I then went from there to a meeting of the International Chamber of Commerce, a group of CEOs, mostly Asian CEOs in Hong Kong. And of course, the only topic of discussion was the crisis. And it was, the topic of discussion was the crisis, and pretty much the question was, what's America going to do about it? And the implicit underlying premise of most of the discussion was that somehow the U.S. will find a way to stabilize the banking system, get back to consumption, and Asia will go back to export-led growth. And there was a great deal of concern in the audience about protectionism, rising protectionism in the U.S. And I tried to explain that, yes, there has been some protectionist reaction, although in my own view, I find it rather muted under the circumstances. But I made the point that, in a way, protectionism was beside the point because the real problem was the American consumer wasn't buying. And that's kind of the ultimate protectionism. But it didn't convince anybody. And so I think Martin is quite right when he says that the surplus countries are not seeing the problem in anything like the way we're seeing it. They don't accept that surpluses are a problem. And they're not imagining a new paradigm. And that suggests that, therefore, they're unlikely to do the kind of stimulus. And it's important, it's really important, I think, when we talk about stimulus, to think about this from a little bit different perspective. We talk here about macro stimulus and, the government will spend so much money and that'll create so much demand. One thing I think we need to really understand is that the surplus countries, particularly the Asian surplus countries, have built an export-led economic structure. The economy is built to export. It's not built for domestic consumption. And so to get the kind of domestic consumption in a China or a Japan or Korea or Taiwan that we're talking about requires an enormous structural change, which requires an enormous political change, which is going to take time. And so even with the best will in the world, it's going to be difficult for them to move in the direction that we're thinking about. Now, on the flip side of that, we have the U.S., and we've talked about, is the stimulus enough, but we have what we have. And I think Laura's right, we kind of have what we can get right now. And it's important that we have this stimulus, but everyone recognizes that we're borrowing this, that there's, as Laura said this morning, we keep doing it this way. If it's temporary, fine. If it's not temporary, we're in big trouble. Think wartime. We're assuming that we have to borrow our stimulus financing from the surplus countries, from China, Germany, Japan. World War I, World War II, we went to debt of 200% of GDP. We didn't borrow it from the Germans. We organized our own economy. We compelled savings in the U.S. We taxed and we compelled savings. And we rationed. But we financed it ourselves. I suggest we ought to look at some of those measures and think about how do we finance this ourselves without necessarily having to sell T-bills to everybody in the world. Second point is that I think everyone pretty much agrees, it's taken a while, but that in the future, the imbalances are not sustainable. The imbalances that we've seen are not sustainable. And if that's true, then that suggests that in the future, whatever demand we have in the U.S., whatever stimulus however successful the stimulus is, more of that U.S. demand will have to be supplied by U.S. production. And that then suggests that more of the supply of countries like Germany and China and Japan will have to be consumed by them. Now, can these other countries actually consume? Well, let's take Japan. This is a country I know a little bit about. They're in desperate shape, as Laura said this morning. Japan is facing an existential question. The economy is going over the cliff. The population is shrinking. And, you do a straight line projection, and somewhere in the future there is no Japan. But, as Dr. Johnson said, a death sentence tends to powerfully concentrate a man's mind. And so I think it's perfectly possible that the Japanese will do something unexpected. They did it before a couple of times in history. Why can't they do it again? And just think about one thing that Japan could do. visited Tokyo recently, visited a friend of mine. He just bought a new house. Spent a couple $1 million for the house. Nice house. But, you know, my house doesn't cost $2 million, and his house would fit in my garage. And what does that mean? It means he doesn't have 2 cars. He doesn't have 4 or 5 television sets in his house. He does, you know, the size of the house limits what he and his wife, family can buy and consume. Now, when you, for years, you've talked to Japanese, and you've heard Japan's a small island country, mountainous, no space, everybody has to live in a rabbit hutch. It's not true. Japan is not as densely populated as Holland or Belgium. Belgians don't live in rabbit hutches. Japanese live in rabbit hutches because of the tax laws, because of the land regulation laws, because of the farm subsidies, and all those things can be changed if the Japanese really want to change them. And so Steve's telling me to shut up. But Steve, the role is reversed here, my friend. I have the mic.
I've got the control room.
Let me close with just one last thought. And this is provocative, and I warn you ahead of time. But Keynes at Bretton Woods, when they were setting up the IMF, this is something people don't often remember, but you know, part of the IMF's role was to lend to countries with balance of payments difficulties. But Keynes anticipated the possibility and the problem of chronic surplus countries. And his solution to that was to impose tariffs. And so since we know that the surplus countries are the guys who really have to step up and begin consuming, and we also know that right now their mindset is not to do that, we need to be thinking the unthinkable in some ways, I suggest. Thank you.
Great, Clyde. Thank you very much. Nicholas Lardy.
Thank you. Well, I want to be a little contrarian compared to the last 2 speakers. I think China is imagining a new paradigm. They may not, as Martin pointed out earlier, be taking the blame for the current global crisis, but they have been discussing rebalancing their economic growth for a number of years, and I think increasingly they're doing things that will move them in that direction, and I think this could be extremely important for the global economy. China has been a huge net subtractor from global aggregate demand in this decade. They've gone from a current account surplus of $17 billion in 2001 to $440 billion last year. That's going from 1% of GDP to 10% of GDP. Unprecedented. They're far and away the largest current account surplus country. So if they would begin to rebalance, it would make some difference. Now, why do I think there's a prospect that rebalancing could be sooner rather than later? First of all, as Martin said earlier, their stimulus is very large. It's the largest of any emerging market in fiscal terms, and in monetary terms, it's much, much larger. Monetary easing is working dramatically in China. The second thing, which has not been pointed out, is that China's growth in recent years has not been debt-driven. China's household sector, for example, has debt that's 20% of GDP. The U.S. is 100. I think Britain is 110. The household sector does not need to deleverage. And as Martin points out, the deleveraging in the U.S. could be a drag on our growth for quite a number of years. The financial sector in China does not need to deleverage. They never bought any of the junk from Western banks, and they didn't originate any of their own, and their banks are in a relatively strong position. The combination of these factors, I think, makes it likely, or possible at least, that China will be among the earliest countries to recover, and they have the potential for going back to something close to their long-term potential growth a little bit more rapidly. The other point to make is that they are doing things that are going to help rebalance the economy. They are not in their fiscal stimulus program simply adding to capacity. They're doing a lot to build out the social safety net, massive increases in the provision of health care, which over time will reduce the precautionary demand for savings. They've done more on the exchange rate in the last year than they did in earlier years. The currency has appreciated on a trade-weighted basis quite significantly. So I think we'll see a slowdown in the rate of growth of their external surplus. We saw it already beginning in 2008. There was a slowdown. And so China's subtraction from aggregate demand globally, I think, will fall. And China could even merge into a situation where their surplus shrinks in absolute terms, which of course would mean that they were then adding to global aggregate demand rather than, as they have been this decade, subtracting. It won't make a huge difference globally. China's at less than 10% of global GDP, but it's bigger than Germany. It's not as big as Japan. So I do agree, I think, with the general thrust of the panel so far, which is you're going to have coordinated action on the part of all the surplus countries. I think China is the gold standard. Their stimulus program is much larger. There are some structural features in it as well that will help on rebalancing, and I'm hoping that over the next few years China will become less of a drag on growth in the rest of the world.
Thank you very much. Bill Garrity.
Thank you, Steve. I am in business with the Chinese consumer, building middle market malls in third and fourth tier cities in China, targeted toward...
Can you share what a third and fourth tier city means?
Really small, out-of-the-way place.
Like what population?
Well, we would have, these are hypermarket anchored malls that are looking for approximately 300,000 people in a 5-kilometer radius. So I would describe our areas as sort of greater Shanghai, small cities, Wujiang, Bengbu, Shuzhou, not Suzhou. These are cities that would be an hour to 2 hours drive from Hangzhou, Ningbo, Shanghai. So these are cities that exist as a form of urban sprawl or suburban sprawl as the greater Shanghai region expands. These are targeted toward two-income families, the hypermarket anchored, which would be Tesco, Walmart, Carrefour, and then a variety of service-type retailers, electronics, shoes, soft goods. I think in the American context, we call it a community center. So really targeted daily necessity-type retail, not high-end, not first-tier. First-tier cities, of course, would be Shanghai, Beijing, Shenzhen. And I would sort of initial comments would say that anybody who visits China would be very impressed with the physical infrastructure of the country. Airports, roads, power, it's very impressive. It hits you straight away. As you do business in China, you become very aware of the export infrastructure that's there, which goes to the cultural and the systemic orientation toward export industries. So China's pretty capable of turning on the switch in their internal domestic infrastructure and in their export infrastructure. Their domestic consumption infrastructure, I think infrastructure is a word that is identified with China, is very young. And by that I mean if you look at the retail industry, the ability to turn on the switch and generate retail sales in China is very infantile. Is not even the wrong, and it's not a bad thing. It's an emerging sector. It's starting to happen, but it's very, very young. And by that I mean, and I'm really sort of the very, very micro economic guy here, the ability to hire people, the ability to staff stores, the understanding of entrepreneurs to start stores. It's a very mercantile economy and culture. It's a very, some Asian and Chinese retailers are some of the best globally. The sense that, as I looked at the risk, is China materialistic or mercantile is yes, clearly. Is it entrepreneurial? Yes. But is there the history and are there the systems in place, both culturally, practically, legally, to see a rapid rise in domestic consumption? And as an owner of shopping centers and an operator of shopping centers in China, I would say that it's emerging. It's very very underdeveloped, and there's a long way to go. So from my view, I think there's places to invest and do some things, but on a broad basis, it's not going to be any kind of engine to supply demand on a global basis.
Thank you so much. I think this has been a great sort of quick snapshot of various views on the international side. But let me just pose just a couple of questions. I want to maximize the time with all of you. But Clyde and some of you, Nick Lardy and others, focus on the current account surpluses that were built. And I'd like to go back in time for a moment and get at this question of why that happened. Because if you're going to undo them, part of the analysis needs to ask how did it come about. other through normal economic activity. When you look at the 97, 98 East Asian economic shocks, one of the things that happened, particularly in East Asia, was a sort of doubt in the Washington consensus to protect them, to buffer them from the sort of shocks. There was enormous anger at that time among economic authorities in Thailand, in Malaysia, in Indonesia, and others about that. And so they wanted to set aside essentially a new instrument, a new Asian monetary fund, if you will, to sort of look to their interests, their particular unique things. And Lawrence Summers went somewhat flamboyantly out of his way to squash that quite visibly. And when you talk to those monetary authorities who are still around, there was great frustration. And one of the things I think, if you really talk to other folks beyond the question of an economy that sets aside a lot, is that the building of currency reserves was in part the shock absorber about the fear of what might come in the future. Now, I don't know if that is a correct analysis. I just know that that's somehow some Asian economic authorities view the situation. So when it comes down to the question of undoing that, and it raises the question of was that set aside one of the contributing factors to the destabilization that hit our global economies elsewhere. So you're asking them to forego essentially a security blanket, if you will, and I'd be interested in any reactions to that of how we undo it, and particularly with Dr. Summers, who I know is a very smart man, but he's back in the White House. How do Asian authorities look at him, given the memories, if not nightmares, from a decade ago from that? Do you want to respond, Nick?
Sure. I don't think China set out to amass the world's largest foreign exchange reserves, the $2 trillion roughly that they have today. I think they fell into it. They adopted a fixed exchange rate in the mid-1990s to the dollar, and it kept their currency appreciating because they were tied to the dollar. They appreciated by about 3% per year. Their current account was 1-2% of GDP. No external surplus to speak of. After 2002, when the dollar started going down, the Chinese, quite frankly, didn't notice it. Their currency began to depreciate, and by the time we got to the middle of this decade, their current account surplus, all of a sudden, for the first time ever, was above 4%, and as I mentioned, it hit 10%. So they fell into an exchange rate policy that led them in the direction of surpluses. This was reinforced by their own domestic economic reforms. Zhu Rongji, in the second half of the decade of the 90s, dismantled a huge portion of the state-owned industrial sector. Tens of millions of people not only lost their jobs, they lost their pensions, their health insurance, their housing, and everything else. And the household savings rate went from 15% of disposable income to 25% of disposable income in the second half of the 1990s. So, again, the restructuring was necessary, very important for generating long-term economic growth in China, but had some unintended consequences that they didn't recognize soon enough. They're rebuilding the social safety net. They've talked about it, but it has been very, very slow. So I don't think they started out to build up massive reserves as an insurance policy. I think they fell into it. And maybe that makes it easier for them to move away from it than some of the other countries in Asia that may have had different motivations.
Cheryl?
Yeah, Steve, I think it's important to distinguish between two waves of the buildup of the global savings glut that Martin Wolf. One was the 1997, the aftermath of the 97-98 Asian financial crisis, which I've characterized as a shock on the same level of the fall of the Berlin Wall. And there, China's less relevant. It was more of a widespread reaction of emerging economies. The second wave, the second shock, was actually China's entry into the World Trading Organization, which gave corporate America, corporate Japan, corporate Taiwan, corporate Korea the confidence to relocate a lot of production within China and to make China a major production hub, so that you had surpluses that otherwise would have been in Korea, Taiwan, Japan, and other places were in essence transferred to China. So China's entry. Now, we can't redo that, but we can redraw in some ways the incentives and patterns of production and consumption. And one of the points, obviously, is in terms of the other emerging economies is to bring a refashioned international monetary fund back into the picture. The other problem, I think, has to be a fairly rapid evolution of China into a more balanced economy. It's just not possible to have the fastest growing economy. Essentially, personal consumption only constitutes 35% of GDP. It's just not a sustainable global economic balance.
Thank you. Clyde?
Yeah, I think on the issue of the surpluses, I think that the perception has taken hold that the surpluses, that the surplus countries have surpluses because primarily because they're afraid that they need them to buffer against shocks. I think that's not true. I think it's true of an Indonesia and a Thailand and the Asian crisis countries that got really hit. That may be true, but Japan had surpluses long before the Asian crisis. Taiwan, Korea, Singapore. I think that the export-led growth catch-up model, it's based on accumulating surpluses, and it does. And China adopted that model, and I completely agree with Nick. I don't think China sat down and said, oh my gosh, there was an Asian crisis, we have to have $2 trillion of reserves. I don't think they thought that at all. They built a model, and the model produced what it produces. And so if we're going to unwind that, I think it's wrong for us to approach this question from a premise, which is a macroeconomist premise, that, why do they have surpluses? Well, it's because they're buffering against these crises. No, it's a structural, more of a microeconomic phenomenon, I think, than a macroeconomic phenomenon. Now, there's another side to this, which is very important. The U.S., of course, is on the other side with the deficits. Why do we have these big deficits? Major factor is the role of the dollar. You mentioned Larry Summers. Larry's mantra in the 90s was, and Bob Rubin too, strong dollar is good for the American economy. Well, strong dollar is good if you want to sell treasuries. It may be good for Wall Street. It's devastating to manufacturing and to Main Street. Bernard said last night about the loss of manufacturing capacity in the U.S. Well, strong dollar has a lot to do with that. And because the dollar is a floating fiat reserve, main reserve currency, in a way it allows all players to be irresponsible. It allows some of the players to be irresponsible in terms of managing their currencies. And all of the Asians engage in some form of currency management, dirty float, what have you, but all of them manage their currencies essentially to be undervalued to support the export-led strategy. The U.S. has allowed them to do that, or has acquiesced in that, because as long as the rest of the world takes dollars, deficits don't matter to us. Budget deficits don't matter, trade deficits don't matter. We get to live beyond our means, which we have in fact been doing. But eventually, of course, there's a price to pay, and now we're paying the price. So I think that a major element of the future restructuring here needs to be, Martin said last night, I was really interested to hear Martin say this, that the Americans might want to consider trying to foster development of an alternative or complementary reserve currency. I think that is absolutely right. I think, for the United States, a very smart thing to do would begin to prepare now to lead the way away from the dollar as the only reserve currency. It'll enforce discipline. It won't be real happy in the short term, but in the long term, it would make the United States a much more competitive place, and it would prevent this development of deficits. The second major point is this, and this is something that I think I haven't heard anybody talk about in the administration or in any of this discussion. But look, in neoclassical economic terms, if you talk about, where does America have a comparative advantage and what kind of products? Well, surely one of them is microprocessors, the chips that run your laptop computers. 85% of the world's chips those chips made by Intel, and 80% of those made in the United States. So if there's one product in which the U.S. has a comparative advantage, you would say it's microprocessors. Now, Intel just announced 2 big new investments, one in China and one in Israel. These are major investments, $6 billion investments to construct fabs to make these kinds of chips. Let me emphasize, I'm not criticizing Intel at all. If I were Intel CEOs, I'm sure I'd be doing the same thing. But you have to ask yourself a question, why is Intel doing this? It's not labor cost, because there's hardly any labor cost in making a chip. And the capital cost is I mean, there's not a huge difference in nominal capital costs across countries. It's not quality. Intel makes the best quality chips in New Mexico. It's not productivity. The highest productivity fabs are in New Mexico. Why are they going to these places? And the answer is real simple. Tax holidays and capital grants. Now, what's interesting to me is that the Prime Minister of China met with the CEO of Intel to talk about the investment that Intel might make in China. The President of the United States, the Secretary of Commerce of the United States, no official of the United States government has any clue that Intel's making these investments. But yet, once those plants are put in place, that changes trade patterns. That once those plants are in place, they're there for a long time. And that will change the trade pattern. That will change comparative advantage. So the U.S. needs to be aware of this kind of stuff.
Steve, could I just make a two-finger
really
intervention?
Quick, very quick, because I know Des
because I know it's going to introduce.
I understand, but here are the rules. You both get to speak real quickly. I'm giving Pat Malloy the first question under the only condition that the question goes to first Nick Lardy. Nick Lardy is hosting the Australian Prime Minister 12:15, is walking off this stage at noon, and we're going to let this go on. You're not going to ask a question yet, but I want the first question to go to Nick because I want him to weigh in as he'd like, and we'd like to thank Nick in advance because he's got an important obligation to go. We'll keep this going a little longer.
Yeah,
so very fast.
To Martin and Clyde's point, it can't be any reserve currency. In a way, the euro was something of a reserve currency for the last 10 years. It has to be a reserve currency that has an expansionary economy behind it, not an economy like a shadow Germany. Therefore, just having another reserve currency doesn't help unless that reserve currency is committed to expansionary Keynesian-oriented growth.
Des?
Yeah, I was just going to I couldn't resist making a remark about dollar policy. You know, having spent a career around currency crises, it's not a very good idea for a country that's got a dysfunctional banking system, that's got trillions of dollars of deficits for as far as the eye can see, that's got foreigners, central banks holding trillions of dollars. It's not a very good idea for them to talk their currency down. They might get more than they really bargained for. The second point I would just quickly make is I think that it relates to the G20 in general, but China would be a specific case. Time is running out. You know, governments move at one pace, markets move at quite a different pace. You know, I don't think that we've got all the time in the world for China to get its ducks lined up, that if they don't realize that they've got to change rather rapidly from an export-oriented kind of policy, because they really do risk inviting huge protectionist backlash, you know, with unemployment going into double digits around the world. I don't think that the rest of the world is going to be tolerating China continuing to increase its exports, expected the rest of the world to accept those.
Thank you, Des. Pat?
Yeah, thank you, Steve, and thank you, Mr. Schwartz, for putting on and funding this program. Great. I'm a member of the U.S.-China Commission, which is kind of a congressionally chartered and funded think tank about China. We did a hearing Tuesday on China's industrial and how it builds pillar and strategic industries, its industrial policy. One of the things that came up in the hearing deals with the whole imbalance problem. And everyone here has talked about the need to reduce these imbalances. And one of the thoughts that came up in that hearing was something that Warren Buffett put forward in May of 2003 in a Fortune magazine article that we adopt a certificate program. When you export from the United States $1 billion, you get a certificate that permits someone, you or someone else, to import $1 billion. And I know this is controversial, but I think of Winston Churchill, who always said, we armed to parley. Now, we're going into these negotiations to get a rebalancing, and everybody says, well, probably we won't succeed. Well, if you have a weapon like that in your quiver, then it gives you a little more leverage to talk about seriously about this imbalancing, which is killing us. So I just wanted to think if anybody in the panel would
it's going to be Nick Lardy to respond first. But in the process, I'm going to piggyback on that question and ask Nick a question, because you're optimistic that Chinese economic authorities are making the right moves. If China were to make the right moves and say Germany was not, how does the world look in that case? Desmond hasn't said this yet, I think, but Desmond actually has doubts about the survivability of the euro in its current form. But what happens if you get China moving in the direction you're saying? We'll ask him to comment on the Buffett proposal, but I'd love Nick's comments before he has to depart.
Well, I think I hinted at the answer before. China alone is not big enough to really solve the problem in terms of making up for much slower growth of U.S. consumption, which I think is inevitable over the next few years, as Martin laid out. It's the third biggest economy in the world in exchange rate terms, but still less than 10%. So unless you have some coordinated expansion, not just by China, but with Germany and Japan and other surplus countries, I think we'll be in for a long period of much slower growth. Well, we do give certificates there. You know, it's dollars. The people that sell, people that sell things. So I think we have to look to some of the macro policies that were discussed earlier in the morning rather than Buffett's proposal.
Desmond?
I would just say that it should be clear that we live in a very globalized, interconnected world, and that in order for us to get out of this global crisis, I think all players have to be playing their part. You know, that if we get China getting its policies correct, the United States getting its policy correct, but Germany not getting the policy correct, that's not really going to work. If we have a major crisis in Europe, it's going to drag the rest of us down. You know, all one's got to do is just remember a miserable country, I shouldn't say miserable, a small country like Iceland with 350,000 people.
They're miserable now.
350,000 people, if that can send ripples around the system, what is going to happen, you know, when we get a serious banking system going under, you know, something like Austria, something like Ireland, something like the UK. You know, so I think that it's not enough that China gets its act together. It really has to be done in a coordinated way. And my proposal would be to scrap the G20 meeting, to get the 4 largest countries in the world together in a room to figure out really what is at stake and to try to get agreement on it.
Thank you. Let's take this gentleman here right in the middle, the white shirt.
Thanks. John Cavanagh from the Institute for Policy Studies. I was surprised that the 5 of you could speak so eloquently about the global economic meltdown without mentioning what I think most would consider the other giant global crisis, which is the climate crisis. And I'm curious well, one, if you would agree with that in the long run it's of equal importance. And in your minds, are there solutions that solve both? And I guess since so many of you think about China, I'm curious whether in China, as you think of rebalancing and stimulating domestic growth, are they thinking about that in a way that also deals with the climate crisis?
I bet when we have our climate conference, the 5 panelists won't mention all of the stimulus issues. So anyone who'd like to weigh in. Yes, Bill?
Yeah, I'm from the ground level up. I would say that at the local planning level, local stores, state-owned enterprises as partners, there's more receptivity to energy-efficient approaches to buildings than I have generally when I was developing properties in California. And by that I mean talk about subsidies or things they can do to assist in just simply using less power, more efficient lighting. These are not macro issues, but there's great receptivity to it. And also in terms of branding a building as being green and as being environmentally sensitive or having open space really gives you some marketing punch with local consumers and tenants. By and large, my experience in the States was that that had virtually no value at that. So doesn't speak to the much larger issues, but at a very granular level in China with small business people, there's great receptivity to it and great consciousness of it as an issue, which I find to be very encouraging.
Let me just throw out, too, McKinsey, just 2 weeks ago, through their China operation, Jonathan Wetzel just released a major study on how China is moving forward to sort of deal with the cost of carbon and build it in. I have a little video clip with Jonathan Wetzel on my blog, The Washington Note, which is a good resource, but referring to this McKinsey report, so I will refer that to there. Next question before so those who are not going to pose a question to Nick, I'm going to let Nick have the next one. The gentleman in the blue shirt. It's got to be to Nick. Is it to Nick?
Yes, it is.
Okay.
Really quickly, your thoughts on the Stiglitz plan just put forward for the UN to have an economic council similar to the Security Council, and the Chinese plan to replace the dollar with the XDR, or special drawing rights, from the IMF.
Interesting.
Well, I'll comment on the second aspect. This is a paper that was posted on the Chinese website about 5 days ago. I think it raises one of the issues we've been talking about all day, and that is the asymmetry in the international financial architecture, that the reserve issuing country has the ability to finance a large deficit much more cheaply than anyone else would be able to do, and it can work to the disadvantage of other countries. So the SDR proposal, I think, is potentially an interesting proposal to talk about for the very long run, but I think it's, in the current environment, I think it's, entirely theoretical.
Well, I want to thank, real quickly, Nick for being here. We're going to keep going for a few more minutes. I'll give him a line since he's going to be meeting with Kevin Rudd, who's a good friend and very active in the Australian-American leadership dialogue, that before Prime Minister Rudd was Prime Minister, he participated in this dialogue and said, "This is what got me to America." And his wife then kicked him and said, "We spent our honeymoon in Hawaii." So I figured this would be something for him to talk to Barack Obama about. Let me take another question here. Yes, sir, right there. We'll take these two.
Paul Gallagher with Executive Intelligence Review News Service. For Mr. Pretzowitz, your final comment about, or the final thing you raised about Keynes, Maynard Keynes' policy at Bretton Woods, wasn't this in pretty strong opposition to the Roosevelt team at Bretton Woods, and part of the fight between those over the BIS and the desire to get rid of the BIS by Roosevelt? And could the United States have done the Marshall Plan, a straight credit line extension by a surplus country under Keynes' proposal? In other words, this confronts Roosevelt.
Quick response.
Yeah, no, I mean, yeah, of course, and Keynes lost the argument, and we got the situation that we got. What I find fascinating is that we're now kind of circling back to the same discussion, and the Chinese proposal is representative of the need for that kind of a thing.
Yes, this one right here. Very briefly.
Yeah, Peter Heller, SAIS. I feel like we're losing track of the central thing of this conference, which is what's replacing the American consumer, where are we going in the medium run? And Japan and Germany certainly face long-term debt problems that are very, very large. The IMF projections show Germany's debt really dramatically rising. So that even if you got these countries to replace the American consumer today, they are going to have to contract very soon. They're just like our American government is going to have to essentially start addressing its long-term fiscal issues. So I think the issue of what is going to replace and sustain demand looking out to the medium term 2 or 3 years ago is still very unclear. I mean, maybe China can play a little bit of a role, but they also have their own kind of long-term.
Well, I'd only say, Peter, in response that, and thank you for being here, Peter's a great player in these issues as well, that we began this morning with Martin Wolf, and who very clearly said nothing may be the answer. But I think part of this conference has said, from what Bernard Schwartz was sharing, is that there's a role for investment in a kind of infrastructure that leads to jobs, that also creates recurring benefits to the economy over a generation, as opposed to the very narrow-banded short-term side here, plus looking at not a full-scale change. I mean, Clyde's talking about enormous changes in consumption habits in surplus countries, but modest shifts can create there. So you can look at this not as sort of a silver bullet from any solution, and I think in that line, I think this has been very good. But back to the question of what we expect out of the G20, I think George Soros and others have also talked about in his 5-part plan. George has a new book out, which will coming out. But in the process of looking at a 5-part plan, also looking at, I would call it another bubble, but you can create new opportunities in green sector positions, et cetera, that allow you to sort of create consumption and activity in other areas. So that's, I think that would be the Peter Heller look if I were to look at that. But any reactions, gentlemen? Cheryl?
Yeah, I think there's also a confusion that is running through a lot of our discussion between the increase in government treasuries that is going to be issued, because in essence, as Martin Wolf has pointed out, we're going to be replacing private sector indebtedness with public sector indebtedness. And that's why, actually, I think, because treasuries still, in spite of all this problem, is still going to be the safest investment in the world. You're going to be able to actually have a somewhat stable situation going forward if the U.S. government is willing to provide enough fiscal expansion, because in a sense it's going to be backed up by the best debt. At the same time, the actual U.S. total borrowing from the world will probably not be as high as it was during the peak years. The current account surplus, which is what represents what we borrow, we may be issuing more public debt, but we may be actually borrowing a lot less from the world. Therefore, I'm not worried about whether the Chinese are going to be a constant ultimate buyer of U.S. Treasury, because I think they will be replaced in some ways by U.S. bank deposit receipts from increased private sector savings to some degree, even with a modest uptick. So I think the whole debate about whether China is going to continue to buy our treasuries, it misses the point, and misses a lot, if I'm correct about Martin Wolf's interpretation, which is very similar to mine, about what is at stake in this rebalancing. And therefore, this gives us a whole different set of options, which is why I came to the conclusion that our second best option probably is a Bretton Woods 3, where public demand and debt substitutes for private sector demand and debt for a period of time. There's so much slower growth in the export economies. But if we do what George Soros says about supporting developing economies and emerging market economies through this period and pin their growth, and if Germany can get off the dime, then we have a possibility of not an optimal path, but an acceptable path to a second chance at more serious rebalancing that brings China in later on. But we have to get these conceptual issues about what the U.S. is borrowing and not borrowing correct in order to do that.
I'm going to take just 2 quick questions, this one here, and then we'll move on to our next question.
This is Zhang Xin from Caijing Magazine, China. This is following up the other question, because 5 days ago, China's central bank governor Zhou Xiaochuan posted something on the web saying that suggesting as to using SDR as a foreign reserve currency. That's for the longer term. But the second day, his deputy is saying that if IMF is going to issue some debt, China is willing to buy that. So my question is, how do you think this is likely, and what are the difficulties lying ahead? Because when I talk to IMF stuff...
I'm going to have to leave it there. What about the issues if the IMF issues debt and China buying it? Desmond?
Well, I think that is one of the few things on which the G20 will have agreement on, is that they're wanting to expand the size of the IMF. They're wanting to at least double the resources maybe go even further. The U.S. proposal is more like an increase of $500 billion, and I would imagine that China is going to be part of that process. The difficulty, though, is what that is going to do is it's going to raise the question of China's representation, Asia's representation in general, the underrepresentation at the IMF board. The Europeans will need to cede ground, so I don't think that these are going to be very quick. Just on the IMF issue, the fact that you're going to get a larger IMF, if that is all that is achieved at the G20, I think we're in trouble, because $500 billion isn't going to make much difference here or there.
Bill or Clyde?
No, I concur with Desmond completely.
Okay. Bill, any comment? Oh, right here.
Antoine van Akmal from Emerging Markets Management. If I understand all of the panels correctly, there are two big issues. One is we need a shift in global consumption, and two is we need a shift in global competitiveness, ideally toward us, because we have been losing some of it, as you've pointed out. On this first issue, having spent a lot of time in these emerging markets, we should start with one point, which is 90% of emerging markets did not have a financial crisis. They are in fact under-leveraged. 10%, Eastern Europe, did have a financial crisis, but the rest did not. And what that makes possible, I think, is something that we are looking for. Because, yes, China has very low consumption, but in average, the consumption of emerging markets is around 50% of GDP, give or take. Ours is 70%. Ours has to come down, theirs has to come up. Emerging markets are now a quarter of the global economy, just as large as the United States. And the emerging markets are now a quarter and will be a third.
Right.
If we bring that shift down, if that shift is very possible to bring down. The question is, can this shift in competitive advantage be achieved without, we talked about it a little bit, a shift in the dollar? The dollar seems...
Okay. Thank you, Antoine.
Let me give a quick response. I think that's a very good question, and I think it points in a direction. I think there is potential in the developing countries. I've been doing a lot of work in Mexico recently, and two interesting points. One is that the internal Mexican demand is way below what I think it could be because of structural problems within the Mexican economy. I mean, telephone calls cost more in Mexico than anywhere else in the world. Cement in Mexico costs a couple times what it costs in Texas. You have monopolies and other impediments in the domestic economy that are impeding growing domestic consumption. A second problem Mexico has is that, one, it's an oil producer, but two, its economy is very linked to the dollar. And so strong dollar also means strong peso. Peso's fallen a lot in this last crisis, but nevertheless, that has, we did NAFTA, and some investment, U.S. investment, went to Mexico to create jobs, but then they all went to China. And a shift in the dollar would have made a big difference in that regard for Mexico. So I think, yes, exactly, you're right.
Good.
Yeah, Des?
I just want to make the point that one doesn't really want to only emphasize the need that you've got to change competitiveness. What is the more difficult job to do is to change the saving and investment imbalance that underlies your external balance. So you're really wanting to do the two things. But just in terms of emerging markets, if the global economy is not healthy, emerging markets that might have their finances in good shape are going to get really hit. You've just got to look at what's going on in Latin America. Commodity prices collapsing isn't a really very good thing for the Mexicos, Argentinas, Brazils of the world.
I would just point out in our briefing book for paper, we somewhat confirm your point by focusing on the BRIC economies, and the GDP of the BRIC countries accounted for 16% of the world economy, but their consumption in those economies only accounted for 7.6%. So if you have an improving, rising living standards over the next decade that brings that up to, and a lot of that obviously is China, but that there's improvements in India and Brazil and other countries, Mexico, that could be. That again is that long-term rebalancing that we're pushing and talking about. The question is how we build a bridge to it, because I do share Desmond's concern that countries that are otherwise relatively healthy may become yet victims of this crisis if it goes on too long.
Your statistics show that China is the outlier.
Yes,
a final comment from Bill Garrity.
I was going to say that domestic consumption is not a governmental choice. So if China and Germany show up and say, yeah, let's go, we will seek to become larger participants in global demand, it's going to take quite a bit of time for the people groups and the culture itself to change and to turn into a consumer, presuming, of course, that those people groups want to live that way, that they want to increase their level of consumption. So you've got, so we can analyze these from a top-down level and look at, and if the governmental authorities choose, it does not mean that individuals will elect to spend their money and live their lives that way. And even if they do, it's going to take a very long time for those shifts to actually take place in the global economy.
Clyde wants to respond. I've got a funny line.
Really quick response to that. Yeah. I'm very much in sympathy with what Bill is saying. But I do note that Korea, after the Asian crisis, began to extend consumer credit, and consumption took off in Korea. And one of the governmental controlled factors in Asia is that consumer credit has typically been suppressed as part of the export-led strategy. So I think there are things that governments can do that will affect that, although I take your point very seriously.
I can see the headlines, consumer credit, be like us. Or be like, please help me thank Cheryl Schweninger, Desmond Lockman, Clyde Prestowitz, William Garrity, and of course Nicholas Lardy, who's joined us. Thank you guys. Please do not rush it. We're going to move immediately to our next session with